the order of events today, I will quickly run through a little bit about the firm, give you some ideas relative to income tax and estate tax, and then I'm going to turn it over to Daniel, who's here from Avantis. Avantis is one of our partner groups that we work with. I will proudly say that we use them only because they're the best. They've never paid us anything ever, and they are here because they're worthy of being here. And that's something that's consistent and true about everything we bring to you. There's never a conflict of interest, a commission, a kickback. Everything we do for our clients because we know it to be the best available. And that's our job, is to sort through the news and the noise of the day to bring you and our clients the very best that's out there. And without further ado, I'll try and kick this off. So very quickly, I just want to remind people about the options when it comes to highly appreciated securities, because selling them is generally the one thing we want to avoid at all costs. Remember, our firm was born out of a CPA practice, so I know I'm talking to some of my colleagues here, but when we see businesses, houses, assets sold with a gain, it makes our stomachs cringe, because there's generally something we can do if we put our heads together, but things like charitable remainder trusts, I think charitable is up to you. You don't actually have to be that charitable to be considered a charitable remainder trust. There has to be some charitable component, but that's a vehicle that does allow a disposition of an asset in a very tax efficient way. Donor advised funds, we encourage everyone to use a donor advised fund. Anyone who's giving any charity at all should be using a donor advised fund. You can set them up for a minimum of $1,000, and we can just easily set them. We'll gladly do them. As a rule, our firm doesn't build on our donor advised funds. We do it as a service to the community and our clients. It's a really, really great way to give charity. So when I was talking to Mr. Jones about a personal residence that one of his clients is selling, I don't know where you are, Tom, but Mr. Jones.
My bad.
There you go. Even a personal residence, you can use some of these tools to escape, avoid, and defer income tax. The other thing that we like to see now is this upstream gifting idea. It works really, really well to move assets into older. All of our estate planners went to law school for 3 years and learned one thing: to get assets down. That was the focus in law school for estate planners. But there is a strategy which sends things up so that when the old people die, there's a step up in basis. And I just want to suggest that if you have family members who are nearing the end and highly appreciated assets, there is an opportunity to take advantage of their unused exemption to get a step up in basis. So we can talk more. I know there are CPAs in the room that can kind of fill you in on the details, but there are some pretty clever ways to take advantage of that. Of course, we're living in an expensive tax state, right? You don't have to move for your assets to move. There are ways to set up trusts in one of the 13 states, 11 states that have no income tax and avoid current income tax on the assets or gains on sale indefinitely or a significant deferral depending on the structure. But that's a common strategy that we're seeing and we want to think about. The other thing is often spreading income. Oftentimes you have these multi-generational businesses and all of the income is being generated and reported by G1, and you've got G2 and G3 who are living off that. And you find that G2 and G3, Generation 2 and Generation 3, are not reporting any income tax at all. They might be living in low tax states, no tax states. They might have really, really low income tax positions. And there are ways to shift reporting of that income to family members or beneficiaries who are otherwise taxed at a much lower rate. The other, I want to be very mindful of time because the day ended up being a beautiful day and I want to make sure you could see the views and enjoy the rest of the day and give Daniel enough time. But one of the interesting things we do at RVW all the time is what we call position optimization. Position optimization is where we put certain assets in certain account types. And that's, I think, something that we're pretty unique at in terms of being so thorough and diligent about that. But I'll give you some examples of that. If you have a foreign stock, for example, your foreign stock is going to give rise to a foreign tax credit. If that foreign stock is held in the context of a pension, you lose the foreign tax credit. Or if that foreign stock is held in the context of a living trust in your taxable account, that foreign tax credit will be reported as a dollar-for-dollar credit on your federal income tax on your Form 1099. So why not take advantage of that position and put it into your taxable account? Small growth stocks tend to do a lot better over time, albeit with more volatility. Let's put those positions in the Roth IRA, the last money you'll spend. So those are some strategies, just a couple of examples to think about, putting the right asset in the right bucket. If you're investing in real estate, make sure that's in a taxable account because it's extremely tax efficient. If you're investing in private credit, make sure that that's in a retirement or a pension plan because interest income is tax inefficient. So we always want to be thoughtful as to what goes where. Okay, just a quick aside here. I'm an evangelist of term life insurance, big advocate of it. You, kids, grandkids, make sure everyone who's got people who are depending on financially, you have a nice term life insurance position. We really like laddering to make sure that the term coverage matches their needs. For young people, 20, 30, 40 years old, you can generally buy $1 million for a few $100s a year. So it's sort of my big, I'm on my soapbox about that because all too often in our community, and it happens about once a year like clockwork, a young family will lose a breadwinner and then it becomes the community's obligation or whatever. Just wanted to bring that to mind. I call it love insurance, not life insurance. So if you love your kids or your spouse, either, by the way, the kids or the spouse, you need insurance. And then a quick mention on the Secure Act. A couple of things that are changing. First of all, RMDs are going up to 75. So they were 70, now they're 72, now 75, which is just interesting to be mindful of, helps with your planning. For those businesses that either missed out or are continuing to have a hard time, a lot of the COVID protections or rescue programs are getting sort of another bite at the apple. So if these acronyms mean anything to you, EIDL, PPP, ERC, bottom line is if you have businesses that are suffering or did suffer, probably worth revisiting that to see if there's another bite at the apple for some of the rescue programs. Higher catch-ups in the pensions, they went from $7,500 to $10,000. $2,500 difference. It's not a huge difference to us living in sort of a 20-mile radius of this area, but we are in the United States of America, and there are obviously huge regions where that is impactful. And then here's another interesting thing it's going to sound a little bit crazy. It's a little bit crazy. I'm going home today and I'm opening up a 529 for myself. And I'm going to put $10,000 into it. Because in 15 years, I'll be able to convert that to a Roth. That'll be about $35,000 or $40,000. And it's just a cute, quick little way for me to effectively get 10 grand into my Roth this year. So it's a little bit outside the box. I'm going to tell my dad, who's 72, to do the same thing, with higher degrees, no intention of going back to college, to open up a 529 for himself. Put 10 grand in it. In 15 years, it'll be a Roth convertible asset. So just a kind of a cute, I think it's a little crazy. I've got my bachelor's and my master's, no intention of pursuing a PhD, but I'm still going to open up a 529 for myself. And that's new. You can use 529s. So 529s have become a lot more flexible in the last decade. 529s were a great way to do college, but now you can do K through 12, and now you can do a Roth conversion. 529s allow you to move assets. Let me back up. 529s are educational savings accounts. Sorry, I apologize. I assumed. And in the old days, they were limited to college. And if they were unused, they were subject to tax and penalty and a real hassle. Now you can use them K through 12, so you got more flexibility. And now you can even use them, the excess unused amount, convert to a Roth if it's been in there for 15 years. And then you can transfer them to siblings, and it's just a very interesting strategy. So, for what it's worth. And then one more piece of economic business I just loved and I wanted to share before I pass the baton to my colleague Daniel. I'm going to throw the R word out there, recession. There's a couple things that are going on in the environment right now which give me great confidence. And this is a good segue, Daniel. Hopefully you'll build on what I'm saying, not correct me. The first thing is that there's full employment. Who here has a business and has tried to hire anyone in the last year? I can tell you, on my credit card bill this month was a $25,000 payment to ZipRecruiter because we are desperately trying to find jobs at virtually every level. We are offering relocations, we are offering signing bonuses. You cannot find people. I guarantee you this club can't find anyone in anything. Managerial, maintenance, food service. You have absolute full employment. That's one ingredient. You have absolute full employment. And if anyone here has found a great hire recently, you have found a gem. Go home and tell that employee that you love them. The second thing that is happening right now is that every one of us can borrow. Every one of us can go into a bank and borrow. I can go get a car, I can get a home. I might be paying 6%, I might be paying 8%, but I can borrow. When you have those two ingredients, my view is you don't have a recession. You have full employment and access to capital. But let's look at what's going on in the world. So only 12% of managers at the Russell 3000 level group, 12%, have used the word recession in their most recent quarterly reports. 12%. So when you look to industry, they're not behaving, they're not manufacturing, they're not, or curtailing manufacturing, or curtail construction, or curtailing expansion based on the fears of recession. I mean, maybe 12% are considering it, but that's not a meaningful number. So I'm very, I think Zahava, we were talking earlier today, I'm very optimistic. I'm not necessarily optimistic for this week, this month, or this year. Because as we've said to every one of our investors all along, equity markets in the short term are wildly volatile. And there's too much uncertainty. We don't need a memory longer than 2, 3, 4 years to know how much uncertainty there is in the world. But all bets are off when you look at short time periods, 2, 3, 4 years. But for those of us in the room who have portions of our wealth, which we can be long-term, which we can be strategic about, and we continue to be very confident that equities will over time prove to continue to be a good way to grow wealth. And with that, I'm going to turn it over to Daniel. So thank you.
Jonathan, thank you for that tip on the 529. I will be opening up that 529 account for myself. It's a pleasure for me to be here with you talking about investments. I've been asked to talk about a few topics. One is, let's talk about the market environment we saw last year, then talk about some perspective around investing in turbulent times. And then lastly, we'll talk about the active versus passive investing debate and some of the evolution that we've seen more recently. All right, so I'll make sure to leave some time at the end of the presentation for questions. If there's any urgent question you want to ask, please just raise your hand and I'll make sure to call on you as well, okay? So let's start with the market environment. So this is what we saw in 2022, last year. On the left-hand side is US returns. In the middle, non-US developed markets, and on the far right-hand side, you've got emerging markets. The proxies that we used here are Russell indices, and then you've got MSCI indices returns on the far right-hand side. What should stand out to you, and I apologize for the small font, is that all of the returns were negative. There was no safe haven. Even if you looked at fixed income, which we're not showing you here, the Bloomberg Aggregate Index, which is the common benchmark for fixed income, was down 13%. It's the worst in its history, 40 plus years. It's the worst return. So the only positive spin I can put on this is that your advisor had plenty of opportunities to tax loss harvest, not only in equities, but also in fixed income. Within the equity markets, you'll notice the left-hand columns, the left-hand columns that represent value are actually holding up better than the growth columns on the right-hand side. Value stocks actually outperformed this year, and that's on the heels of value stocks underperforming for what seems like many years prior to this. So value investors rejoiced in 2022, even though the market was down overall. I'm going to show you a slide on the world here in a really small font. What you're looking at here are returns across each country. And the point that we want to make here is that there's a lot of dispersion. There's a big difference between the best performing country and the worst. Chile was up 22%. Korea was down 29%. It's a big difference. The big country that we're not showing you here is Russia. There's no return for Russia. Why is that? The return for Russia was negative 100%. And that's because when Russia invaded Ukraine last year, the West put sanctions on Russia, which made it impossible for investors to actually invest in Russia, so prices went down to zero. Also in the news, you had China around its COVID zero policy and relieving the COVID zero policy. China was down about 21%. I'll finish it up with the US, which was down 20%. When I say the market, most of you here will say, oh, that's the S&P 500. I will focus on the S&P 500 because that's what most folks tend to be interested in. This was the S&P 500 in 2022. Big downtrend. At the worst, the S&P 500 was down about 24% in October. It recovered a little bit in the fourth quarter to end up down about 18%. Along the way, what we saw was plenty of headlines, plenty of negative headlines. There's concerns around high inflation, high oil prices, Russia invading Ukraine, recession, you name it, it was there. There's plenty of negative headlines here. So you had a negative 2022. We had lots of clients asking advisors, okay, I see all this, we just had a very painful period. I'm seeing all these negative headlines. What does this mean going forward? What does this mean for my portfolio going forward? Am I going to experience more losses? And so the answer to that question is one that I can't give you too much insight on. We don't make predictions when we manage our portfolios. But what we can do is provide some historical perspective and some framework of how to think through things. So what are the variables that are driving the returns of stocks over this time period? So I'll walk through that, and then based on those variables, we'll cover why the markets went down and what we can expect going forward. Sound good? I'm going to skip all this. I'm just going to focus on this. When you buy a company, what are you buying? You're buying a company's earnings. It's future earnings. And because the earnings are in the future, $1 in the future is not the same as $1 now. And so what you have to do is you have to discount that $1 in the future by a discount rate. So the price is equal to the earnings of a company, and you have to divide it by a discount rate. This discount rate is important. Why is it important? That is what you require as an investor in terms of your expected return. That is what the market requires when they invest in a company. If you want a higher expected return, this number goes up, well then the price has to go down. You're willing to pay less for a company because you expect the returns are high. In what environment do prices go up? So when earnings are up, and when the discount rate, your required rate of return, goes down. That's when prices go up. That's when the markets go up. What did we see last year? What did we see last year? What we saw was signs of an economic slowdown. And what happens in an economic slowdown? Usually demand slows down and earnings start to decrease. So you've got the numerator here decreasing. There's some uncertainty in the marketplace. You saw the negative headlines. So what happens? You as an investor say, in order for me to invest in the market, I need to be compensated for that. My expected return is now higher. My hurdle is now higher. So the discount rate is going up. Earnings down, discount rate up, prices down. So it's not too surprising that in 2022, in hindsight, that the market was down because earnings were going down and investors' discount rates were going up. Now, back to the original question. I know that there's a lot of headlines still around. We're talking about recession here, we're talking about inflation. Does it make sense for me to trim my equity exposure? Does it make sense for me to not invest any more money into equities for the time being? That's a very personal question, and it depends. But let me provide some historical perspective here. What you're looking at is economic activity. This is not the stock market, this is economic activity. And what we're showing you here is a business cycle. So peak economic activity, as you go down to the economic trough, that is economic contraction, that's a recession. Now, as you go from the economic trough up to the economic peak, that's an expansion. How did the stock market do? We're taking data going back 50 years. How did the stock market do in a period of recession? By the way, this average recession period is about 11 months. The average expansion period is about 72 months. The average monthly return during a period of recession was negative 21 basis points. So over a year, it's about negative 2.5%. The average monthly return in an expansion was about 1.2%. So that gets you to roughly 14% for the year. Over this entire time period, you get about 1% per month return, or 12% return to be invested in the equity market. That's the entire time period. Can we use this information to determine, do we get in or do we get out? What's the problem with this information?
You don't know where you are.
Exactly. You don't know where you are. Where are we? I don't know. I don't think we're here. Maybe we're here, maybe we're here. You don't know where you are. And it's really important to know where you are. You don't know where you are until many months later, until after the fact. It's very important where you are in this recession period, because let me show you some additional data. This is what happens in the first half of the recession. So I said that the average recession period is about 11 months. So let's cut that 11 months into two periods. The first 5.5 months and the second 5.5 months. During that first 5.5 months, you'll notice as the economy peaks, it's starting to contract. It's just starting to contract. You'll notice that the market is down 2.5% per month. You started at the peak. It's just starting to contract, yet it was down 2.5%. So the market reacts very quickly to any kind of contraction in the market or economic activity. Let me show you the second half. The second half, as the economy is contracting and it hasn't yet reached the bottom, the returns are actually positive. Why would that be? Why would the market be up on average, even though the economy is contracting? It's because the market is forward-looking. It doesn't care about what it sees in the past. At any flicker of hope that the economy is going to start picking up again, it will price it accordingly. It will cause the market to go up. Even as the economy is still contracting, if there's any flicker of hope that there's light at the end of the tunnel, the market reacts. And then, of course, as you go through expansion, the average monthly return is positive across that entire time period. So it's critical to understand where you are. And it's very tough to determine where you are in this contraction period. How about companies that are cheap, have low prices, but have high profits? Small value companies. How did those fare in this environment? Well, they're down just like every other company in the first half of the recession. But if you look at small value in the second half of the recession, they're up 2.95%, a bit more. And then in the expansion period, they're up even more. So when you hear pundits say small cap value stocks do well coming out of a recession. It's true. They do very well coming out of a recession, but they also do quite well as you're exiting or as you're entering the economic trough. So going back to that question that I said, does it make sense for me to get out? I've just experienced some pain. Does it make sense for me to get out now? Again, a personal question. What history tells us is that for the investors that have stuck around, they've been rewarded for sticking around during that second half of the recession. It's very tough to stick around during the second half. Let me show you volatility. The markets, as you're entering into the second half of the recession, are very volatile during this period. People are trying to figure out what to do, or trying to figure out where we are. Are we here? Are we here? There's a lot of volatility still. So it's even though it's tough to stick around, this is where advisors play a major role. They can help you walk through your goals ahead of time, and then as this is happening, they can guide you and let you know, well, based on your goals, it makes sense to stick through it. They can hold your hand. So they're in the best position to help guide you. Any questions up to this point?
What does that percent sign mean when it says volatility?
Yeah. So the way that we measure volatility is based on the VIX index. So it's the volatility index, and that's an implied volatility rate based on futures options. So it kind of gives you a sense of how much volatility is in the marketplace at a given time. I'm going to switch gears here because we've talked about valuations. These are valuations. We get lots of questions around, well, the market's also run up quite a bit. Well, you've heard the ARCs of the world, the Googles of the world, they've done really, really well. Our valuation's stretched. Are things getting too expensive? What we're showing you here, and sorry for all these lines, each of these lines represents a part of the market. They're indices. And the line that stands out should be this blue line, which represents large growth companies. And part of those large growth companies would be your FANG stocks, your Facebooks, your Amazons, etc. This is data going back to 2000, and you'll notice that from 2000 going through to the current period, valuations for those large growth stocks have run away. All the other markets, international, emerging, small cap, they've kind of stayed steady. So based on the historical valuations, large growth were well beyond their historical valuations. They've come back since. They're about equal to what they were in history. Where there's still some relative value to be had is the Russell 1000 value, or the large value stocks, small value stocks, international and emerging markets. That's what we've seen in history. That doesn't mean that things can't get worse, right? Valuations could get even more attractive, but at least we can give you a historical perspective as to where valuations are. All right. I'm going to talk a little bit about active versus passive investing. And who here is kind of thought about this active versus passive investing debate? Just curious. None. All right, let me walk very briefly through the active part. So when you're talking about active investing, it's managers that are stock picking. They're picking the stocks that they believe have the best valuations, that they think have the best potential for return. And when you have these active portfolios, they tend to charge higher fees for them. They tend to be a little bit more concentrated, so they have less names in the portfolio. But you have that potential for outperformance. If you pick the best stocks, you're a hero. If you pick the worst ones, you're a goat. Time went by, and people started to realize, based on research, that active investing is very difficult to do consistently, to outperform. And so some managers came up and said, let's just do an index strategy that buys a basket of stocks that represents the market. I give up. I don't want to do any active investing. I'm just going to buy the market. And I can do that very cheaply. I can buy most of the stocks in the universe, so it's very broadly diversified. That's an index. The drawback to an index is that, let's take a value index, for example, a small value index. It rebalances only once per year. So let me give you an example. The Russell 2000 Value Index, which is supposed to capture US small value companies, the largest holding last year was AMC. AMC is the movie chain that we heard about, the meme stock, that had a huge run-up. It's not value, it's growth. It's not small anymore because it's had a huge run-up, and yet it's the largest name in a small cap value index. Why is that? It rebalances once a year. It was small value at the beginning of the period, but at the end of the period, it was no longer small in value. So that's a drawback of index funds. The drawback of active funds, you're paying a high fee, it's a little bit more concentrated. Drawback of index funds, yeah, it's cheaper, it's broadly diversified, but you're using stale data. What you're really after is a broadly diversified portfolio. Low fees, tax efficient format in an ETF, but has the ability to outperform. And that's where we fall in, is in that camp where you're low fees, broadly diversified, tax efficient. Focused on higher returns daily, not just once per year. How did we get to this from here to here to here? There's an evolution along the way. There's a science, a financial evolution along the way. With computers and the greater computing power, it's turned investing from more of an art to more of a science. That's based on data. That's based on evidence. So what do I mean by that? If you have financial research, chances are that financial research is going to do a regression analysis. Now let me explain regression analysis. If I wanted to know what the relationship between age and height is, I'm going to take the height of a 1-year-old baby to a 2-year-old, 3-year-old, I'm going to plot it on a graph, and I'm going to see a relationship between age and height. I'm going to draw a line through that plot, and now I have a regression. I've got a regression that tells me this is the relationship between age and height. Now, financial science does the same thing. There's a lot of variables that it looks at to try to figure out something that predicts stock returns. And so the very first one, the very first model that they did was one that was based on volatility, helps predict stock returns. That was back in 1964. And the computer used to run that analysis was a mainframe that was the size of a room. Something that we could now do on an Excel spreadsheet. Computing power has gone way better, has been way better since then. And so you've got a lot of research now that are saying, okay, let's look at companies that are small versus large. Does that have any predictability on stock returns? Well, how about low price companies versus high price companies? How about ones that have high profits and low profits? And so those are called factors. That's factor investing. There's a whole new world that focuses on factor investing. But the only issue with factor investing is that it's based on data. You're just looking at data. If I were to tell you that stocks that start with the letter A outperform stocks that start with the letter J, would you create a portfolio around that? Probably not. There has to be some economic reason why those should be outperforming. And that's where we're back at. We have to go back to evaluation framework. I showed you a very simplistic framework before that just said profits divided by discount rate. When you buy a company, you're taking into consideration the company's profits and discount rate. Let's all together here. Let's say we decide to buy the Calabasas Country Club. How are we going to price it? We want to know what the assets of the Calabasas Country Club are, what the land is worth, but we also want to know what the liabilities are. So that's your equity. But you also want to know what are the future profits of Calabasas, right? Okay. How much we want to make as the discount rate. If we want the discount rate to be higher, if we want to make more money, then we pay a lower price for Calabasas. If we want the discount rate to be lower, then we're willing to pay a higher price for Calabasas. What we're doing instead is we're saying, for a traditional active manager, what they're going to do is, let's solve for price. I'm going to come up with a price using certain analysis. I'm going to say, what's the equity, what's the profits? I'm going to have an assumption around discount rate. I'm going to solve for price. But let's do it a little bit differently. We know what the prices are in the marketplace. Let's take price as a given. What that allows you to do is buy companies with high discount rates that have high returns. So we're buying companies with a high equity relative to the price you pay and high profits relative to the equity that you get. That's what we're doing. We're buying a basket of securities that have high equity to price, so you're paying a low price for it, and high profits. Does it actually work? This is the data. Okay? We've color-coded it here. This is profitability, and this is the relative price you pay. If it actually works, then these companies here that have low prices and high profits should give you higher returns. And as you go here, the ones that have low profits and high prices, they should have lower returns. This is data going back to '73 in the United States. Large cap stocks return 12.44%. But the difference in returns between those green companies and the red is about 5%. And if you look at small cap stocks outperform large by 2.5%. But the return difference here between green and red is 10%. Why does this matter? If you want to outperform, you want more companies in green. One of the strategies that we offer is a strategy that buys everything here, but just overweights the green companies and underweights the red. That's AVUS, that is what RVW has as an offering. This is what we do. So up to this point, I have not made any predictions in this entire presentation. We don't stop. What we offer are portfolios that are focused on the green to give you higher returns. These are just building blocks for our advisors, for our clients. It's really the advisors that are in the best position to determine, based on your goals, based on your tax situation, what strategies to use, and to help you walk through the turbulent times. All right. There's a question.
Other than the daily trading price, how do you emphasize that you do daily analysis? What does that mean?
Yeah. So prices change daily, but also the earnings of a company will change. The earnings of a company will change.
That you have access to daily?
We have the earnings of a company on a quarterly basis. So as prices change daily, a name that used to be in the green may now shift down to the bottom. Right? Prices change, your earnings change. It's quarterly data. It's not everyday data. It's not a company that doesn't give out their earnings on a daily basis. But you have to use the combination of the most updated earnings that are provided and the current price.
The reason I'm asking is because on your recession, all of this is excellent. It's really interesting.
Yeah.
On your 11-month recession, program,
Yeah.
when you're looking at data from a company that's published, even once it came out, it's already, at best, 6 weeks late for a period of, months earlier. I'm having trouble grasping how you would change what you would do.
Yeah. Yeah.
Until then.
Yeah, so when you're looking at a company's earnings, you're looking at a company's earnings 12 months ago, for trailing 12 months. That's what we use as, high profits, right? A company's current earnings have pretty good information about a company's future earnings. A company that's profitable now tends to be profitable in the future. It's not a perfect science. It just gives you information that you can use to target companies with higher returns. And I'm happy to talk after the presentation. We can talk in a little bit more detail.
Can I give an analogy to what Daniel was saying? I think we look at the medical community, it's a good example, great example. 50 years ago, you went to your doctor and he was giving you advice based on his experience and the experience of his mentor, and that's it. That's how you got treatment. That's how you had the surgery. That's how you got the medicine. Today, when you go to the pharmacy and you get your 10 milligrams of whatever, that has been studied with such vast numbers, with double-blind studies and independent reviews. Your medicine today is done through a scientific, research, methodical approach. Your portfolios that we manage and do with Avantis are done with that same level of science, numbers, data, and research, not gut and intuition. And when you talk about active management, it's all gut and intuition, all of it. What to buy, what to sell, when to get in, when to get out. There's no data. It's because the guy loves his car, it's in your portfolio. It's because that's where he used to do his research before ChatGPT came along. That's what's in your portfolio. That's not a way we do medicine today. That's not a way you should run your portfolios today. So I wanted to give you that good analogy.
That's great.
The other quick thing is that active management tends to look back. Right? What worked well last year? Terrible way to run a portfolio. Right? What we can do here with Avantis and the data we have is use real-time current data. That's not forecasting and predictions. Daniel's been very careful. We do not forecast. We do not predict. We use data and act on current, real data. And that's
The critical component here is we use stock prices. Stock prices are forward-looking. Markets are forward-looking. The market is giving you an implied discount rate or expected returns based on prices. That's how it changes expected returns. So we do use forward-looking. It's the market's forward-looking estimate. And it's real-time. It changes real-time.
So thank you
very much for your time.